So let's talk about the economy. And this is where I start to sound like a broken record, because for the last year and a half, 2 years, 2.5 years, I've been of the mindset that our economy is not in terrible shape. That we came out of the pandemic, a lot of companies were able to strengthen their position. A lot of companies that were weakened during the pandemic made changes to adjust their operations to reflect a new reality, and have since gone on to become better for it. Peter Lynch used to talk about in his books, wrote that that recessions were good for companies because it caused them to shed unneeded assets. It caused them to become more efficient. It caused them to adjust their operations. And then at the end of the recession, they were poised for growth mode in a leaner, meaner position of strength. And I think that's what happened during the pandemic for a lot of companies. Yeah, I know that there were a lot of businesses that were adversely affected, a lot of pain and suffering, but I think by and large, many public companies were able to make adjustments. I think also many companies coming out of the recession were able to use the cover of supply chain issues or rising input costs as a means to raise their own profitability, which I have mixed feelings about that from an ethical perspective. It feels a little like price gouging, but and I think that's largely receded now. But when you kind of put this all together, my vision at the end of 2021 and into 2022 was that the economy was not looking like it was going to fall apart, where it looked like we were going to be able to see gradual economic recovery, that we wouldn't see a continuous long settling into recession in the US. And that there were so many mixed economic signals that meant you could point to something negative like the unemployment figures in 1 month, and at the same time you could look at manufacturing, or you could look at energy and input costs, or you could look at housing starts, and those would be positive. And so that's not the recipe for a dismal economic outlook. So another part of the problem is that Americans just haven't seen inflation or high interest rates or bare product shelves in such a very long time, that when they were confronted with grocery store shelves during the pandemic and after the pandemic that were short, that people went into panic mode, probably unnecessarily. The truck was just a week late, but everyone then is in the mode where they want to make sure they've got what they want, and so they're spending as insurance to stock up on goods and products and groceries and foodstuffs for their pantries, probably unnecessarily. Companies doing the same thing, stocking up because they were afraid that they wouldn't be able to get the materials they needed. And then the day of reckoning comes where you've got all of this stuff and you don't need it. And then how do you react to that? So I'm still in this position. I think the chance of a recession at this point is possible, but if it happens, I can't see that it is going to be very long in duration whatsoever. The economy are we worse off than we were 2 years ago? I don't see that to be the case, and I think it's likely that we've seen the worst. And I'm certainly not betting on further widespread economic deterioration. And if you are worried about that type of deep economic chasm that so many commentators seem to think is happening, the alternative is to consider what's on the other side. What's happening? What's likely going to happen after the recession ends? How long is that recession going to be? When you look at the history of recessions in the modern era, it's unlikely that a 3-quarter recession anything longer than that, it's unlikely that it would happen. Companies today are much more facile at recovery when a wrench is thrown into their works because of declining demand or rising costs. Companies can modulate, they can adjust and adapt like they couldn't in the 1960s or the 1970s, the 1980s, right? So that all bodes well for the state and health of American business. So I am decidedly in the camp that says, you know, we're not saying everything is rosy, but I don't think we're going to descend to the point where we have a classical recession at this point. And interestingly, when you look at our coverage list, which hopefully is a subset of companies in particular industries selected for quality and other attributes that make them attractive to investors. But so far this year, of the companies that we recommended early so far in 2023, of the 12 companies, here are 7 of them that we selected, even though they were in classically cyclical or sensitive industries, uh, because of our belief that we could invest in them at these bargain prices and get in before so many other investors, and then benefit from the run up if we had a recession and they sat and lingered at those lower prices. Okay, well, we were a little early. But what's happened is quite the opposite. Uh, our 2 big building material stocks that we cover, Simpson Manufacturing and Eagle Materials, are up 60.7% and 34.2% since the issues they were recommended in. Simpson was covered in the January issue, published at the end of December. It's up 60% since then. This is not what happens during a recession. Eagle Materials makes the plasterboard and concrete, profiled in March, is up 34% since then. Marine Products, the boat maker in the RV industry, profiled in May, is up 28%. Hawkins, Specialty Chemicals, Cadant, Specialty Industrial, up 24 and 20% since February and January. Our retail REIT stock, again, Alpine in August, up 4%, and they haven't even paid any of their dividends yet with that 3% plus yield. And Perry Network in advertising, featured in March, up 2.4%. Again, in a recession, that stock would not be rising whatsoever in a traditional recession. So is this the right time to invest in cyclicals? I have to say that if your company selection is good, maybe there are opportunities. The home builders are still a little bit on the fence. They're juggling higher input costs as well, but demand is so high for homes, especially in the areas where stocks that we follow, like Century Communities and LGI Homes, there's demand for homes in those areas. They're able to raise prices and are benefiting from it. But the housing is a big, complicated issue in the U.S. So we'll wait to see in the next next quarterly report, how those companies do. But I just thought it's interesting that we haven't been shying away from the classical cyclical or sensitive stocks, and they have performed well for us.